I'm not buying, Carl. I'm very, very wary of the price here. This is a wonderful business. The quarter was terrific. There are some cash flow problems. They're spending a lot of money on advertising. They're spending a lot of money on content acquisition. Content assets went up. But the principal problem is the multiple. The stock's growth is practically unique in our entire economy, and as such, it's gotten a scarcity valuation. And if you're looking at an environment where the Federal Reserve is going to raise interest rates, that scarcity valuation is going to be squeezed. Second problem that I can see is that there's a tremendous proliferation in people who want to make content. It looks like the new gold rush. I went on to Metacritic this morning, and there are 88 serialized content productions that are currently rated by Metacritic. And in an environment now where people are watching more sports, NFL ratings are up, I think the World Series ratings are going to be up. There's less time to watch this content. There's too much supply of content, and I think too little demand. So I think at 100 times cash flow, this stock is very, very fully priced.
Paul Holland, something tells me that you disagree, but the valuation on Netflix getting pretty close to Disney, it makes me feel like maybe it's getting close to a zero-sum game valuation. But, I mean, who thinks Disney's really going to fail here? Once you got Marvel and Lucasfilm and all of that on a subscription service, aren't people going to have to buy it?
Well, I think your first assumption was correct. I am going to disagree with Larry on sort of two fundamental assumptions there. I've been listening. We invested in Netflix back in 1999. We took the company public in 2003, and I respect Larry until the cows come home, but I've been listening to this kind of commentary for, well, the better part of the last 15 years of, you know, they need to show us more profit. Tell us about the cash flow. Tell us about this. Tell us about that. I remember Reed Hastings getting on with analysts very early in the company's history as a public market and listening to all the different points of criticism similar to what I just heard. And essentially he would come back with the same message. You just don't understand how large the market is. And I think that's really what you're getting to, Carl, in terms of your point. Could it come down to a zero-sum game between Disney and Netflix? I don't think so, because I think there's such a broken field out there. I think there's such opportunity. I'm not terribly worried about the 88 pieces of content because, quite frankly, what I want to control is I want to control the distribution of that content. And that's where Netflix is today. And that's why many, if not 99 out of 100 public analysts have miscalled this stock for the last 15 years.
So, Paul, you're not at all concerned about the fact that this is a company that could spend as much as we had Mark Mahaney on the last hour talking about the possibility of $20 billion spend on content in coming years. That, in light of a potentially rising rate environment, that doesn't worry you at all?
It doesn't worry me in the sense that, think of it this way, what has Netflix done incredibly well over the last 5 or 6 or 7 years? They've traded effectively cash that's been raised in various different forms for content. And then they've been able to make that trade-off in such a way that they've converted that into market capitalization. And there's no reason to continue to believe that that cannot continue for quite some time into the future unless you believe they're dealing with a small market. Let's look at the FANGs as a whole. This is one of the topics that we've addressed in the past. You've got $4 trillion market spaces, $1 trillion plus market spaces that they're playing into in social networking with Facebook and e-commerce with Amazon and in media and with Netflix and, of course, in search and advertising with Google. So everyone who's bet against those companies over the last 5, 6, or 7 years has bet wrong for one fundamental reason. They just continually underestimate the market size and they underestimate the strength of the disruptor, in this case Netflix, in essentially dominating that market space. And I think, you know, I just don't know how much more evidence people are going to need to see that they are the force to be reckoned with in a $1 trillion plus marketplace.